In the later stages of a bear market, our strategy starts to outperform. Even it may just be that we're down less than the market. Some days we're up when the market's down. Why? Because during the later stages of a bear market, the new leadership shows up and starts performing. We're the new leadership. We always are. And many people think, oh, I've got myself covered with the NASDAQ 100. No, look deeply into those indices. We are the new NASDAQ. And most of our stocks are not in those indexes.
With a flagship fund that has fallen by over 60% year to date, Cathie Wood's ARK Invest has had several negative media moments over the past year. But the daring, innovation-crazed founder and CIO has continued to make some not-so-silent moves all year long, doubling down on several innovation stocks even as other hedge fund managers run the other way. In one of her previous interviews, Wood stated that truly disruptive innovation will scale from $7 trillion in market cap in 2022 to over $200 trillion by 2030. According to the American investor and hedge fund manager, to be short on innovation now is to risk missing out on massive, unbelievable opportunities. In a recent interview, the renowned fund hedge manager discusses how ARK Invest is properly positioned for insane growth despite the bear market. She adds that as the bear market runs its course, she expects the investment management firm to put in a more brilliant performance and even outperform the markets. Wood also discusses her outlook on the current state of the U.S. economy, supply chain issues, inventory overhang, and the role of technology stocks as the world tries to navigate a huge global recession. We will now take you to Cathie Wood's interview with Bloomberg's Tom McKenzie. Please watch, share, and hit the like button. Also, ensure you subscribe to the channel, turn on post notifications, and drop your comments and observations in the comments section below. Everything helps with the YouTube algorithm so we can continue to bring you these important updates on the markets and the economy. Thanks and enjoy the video.
So it started actually in February of 21. We started declining. Truly disruptive innovation started declining in February of 21, while the market soared to all-time highs in 21, and now the rest of the market is suffering as well. So vaccine, people going back to work, supply shock. The businesses had shut down, wondering if they would ever reopen their doors, right? They shut down. At the same time, governments around the world were stimulating aggressively. So we had a supply shock, especially because demand actually was so much stronger than anyone expected. And I would say, lessons learned, could I have dreamed, a technology investor, that supply chain issues would have lasted more than 2 years? No, I never thought that for a second. I thought we would be over that in a year, and certainly couldn't have predicted Russia's invasion of Ukraine. So the question is this a 70s style inflation, which is how the markets are treating it right now, and why our strategy has been decimated, and most growth strategies have been hurt very hard. We don't think it is. I think the market's pricing is pricing innovation as though we have a bad inflation problem that's going to take interest rates up even higher. We don't think so. We think actually the greater risk and opportunity is deflation. I think we're going to start seeing deflation on a month-to-month basis. We're already seeing commodity prices come down. They've broken down, many of them. That's upstream, at the top of the pipeline. At the bottom of the pipeline, around the world, we're seeing a massive inventory overhang as we're heading into the holiday season. How will they clear that? Discounts. So I think cyclically, we're going to see deflation. We're already seeing it in the pipeline. Secularly, we will also see deflation. We spend all of our research time focused on disruptive innovation, technologically enabled disruptive innovation that is inherently deflationary. But that's good deflation, because as prices for electric vehicles continue to come down, we will see a continued boom in electric vehicles. It will hurt the internal combustion engine cars, but it will help the innovators. So I think we're going into a deflationary period, much like the late 19 teens. So 1918, World War I ended. Spanish flu also hit. So think about that. War, flu, very similar dynamic, right? And the other similar dynamic was 3 major innovation platforms that were going to transform the world: telephone, electricity, and automobile. They were all scaling exponentially and took us into the roaring 20s. So supply shocks took inflation back then to 15%, but within a year and a half, 2 years, that inflation started dropping, and it ended down. I'm sorry, the inflation was 20%. It ended down, deflation, 15%, roaring 20s. I'd like to think that's what we're going into now, and there's a high probability we are. So it's interesting to watch our strategy as fears about Fed tightening and more Fed tightening continue. On many days when the market's down, our strategies are up. Now, that is what tends to happen. I'm not promising this is where we are. My compliance department would never let that happen. But in the later stages of a bear market, we haven't owned the FANGs in our flagship for quite some time. That's not the new anymore. TikTok has come along and destroyed a lot of models. So yes, I think that we're seeing the early stages of a bottoming process. At the same time, many people are saying we're going into a recession. Now, we think we've been in a recession, and that the negative numbers will reassert themselves after this positive third quarter, mostly because of the inventory overhang, and we need to clear that out. I think many forecasters may say, oh, this is going to last forever, this recession through. We think it's just a major inventory correction, and then we'll be on our way again.
As soon as the United States posted its second quarter of negative GDP growth, Wood was one of the first market experts that stated that the U.S. was in recession. Since then, she has repeated similar sentiments in several interviews, tweets, and blog posts. Wood believes that the Fed's Volcker-style sledgehammer is too big for an inflation that has lasted for less than 2 years. In fact, she compares the current state of the U.S. economy to the post-World War I environment and believes we will soon begin to see severe signs of an economic slowdown, not continued inflation as many other market experts are predicting. In her interview, the renowned hedge fund manager also discusses innovation stocks, their role since 2020 and beyond, and the Federal Reserve's aggressive rate hikes.
Innovation solves problems. COVID-19 created massive problems. We needed to sequence the virus to understand how it worked. We needed to develop tests. We needed a vaccine. So no wonder that our genomic revolution strategy was the best performing strategy during that period. Innovation solves problems. We needed to digitalize everything we do. Work, play, healthcare, education, and that innovation helped. Now what has happened since then, because many people think that burst, and from the low in COVID, April of 20 to February of 21, our flagship strategy was at 360%. Now, innovation solves problems, but by the end of all of that, we were saying, okay, keep some powder dry, because our minimum hurdle rate of return for any stock to get into the portfolio is a 15% at a compound annual rate for the next 5 years. We hit that in February of 21. Now with the massive downdraft we've seen, our rate of return expectations have never been higher. I've never seen them higher in my career. Cannot tell you what they are because compliance, of course, has a lot to say about that. But as you said, being down 75% plus from that February peak, when innovation is still solving problems, and we have so many more problems than even during COVID. We have the war, we had all the supply chain problems, and we have a recession, which is going to force most companies to say, how do I increase productivity? How do I cut costs? Technology is usually the answer. So I think we're coming into a moment, hopefully many moments, where innovation is solving problems and our revenue growth rates are going to surpass by far the revenue growth rates that the overall economy will deliver. You may know that we wrote an open letter to the Fed saying, wait a minute, how can the 12 of you unanimously agree on 75 basis points at, one right after the other when commodity prices are falling, inventory overhangs are crushing companies, And so you have upstream deflation. We believe downstream there will be deflation. There's no debate over this? Are you kidding? Do you know that in the early 80s, and I was fairly new to the business, Chairman Volcker was fighting a 15-year inflation problem. It started in 1964 with the Vietnam War and the Great Society. So 15 years, and people were used to inflation, so they were demanding it in wages and so forth. He took interest rates up twofold, 10% to 20%. This Fed has taken interest rates up roughly 16-fold in 9 months. Now, economics takes place at the margin, changes at the margin in all kinds of pricing, and interest rates are prices. Changes at the margin are incredibly impactful. And I think we will look back in history and say, wait a minute, a 16-fold increase in 9 months without stopping to see what's happening is crazy. It's crazy. And this is what will take inflation from up 8 to 10%, where we think it peaked, to negative.
What are your thoughts on Cathie Wood's assessment of her hedge fund's performance and the U.S. economy? Do you agree that inflation is not baked into the economy and we could be looking at deflation within the next year? Please let us know what you think in the comments section below. Also, ensure you hit the like button, subscribe, and turn on post notifications if you are yet to do so. You can also check out our other videos featuring Cathie Wood and several other experts on the markets and the economy. Thanks for watching.